AI stocks are hot, but margins move markets. Cerebras just reminded investors that top-line growth isn't enough when profitability visibility narrows. Shares of the AI chipmaker fell about 10% after its first post-IPO earnings, as management guided to thinner gross margins. That guidance came only weeks after the Nasdaq debut, and it sharpened attention on a classic scaling dilemma. To meet demand, capacity has to ramp ahead of revenue. In the near term, that can compress margins and test valuation support. Cerebras signaled that gross margins will tighten as deployments expand and manufacturing ramps. A heavier mix of full systems rather than higher margin components or software can add pressure early on. Management also flagged timing effects around orders and deliveries, suggesting that quarter-to-quarter results may look lumpy even if underlying demand stays intact. For a new public company, this update effectively sets an initial baseline for expense discipline, capital allocation, and how aggressively it will invest to seize share. Markets reacted quickly because AI leadership premiums are already priced into many names. When profitability trajectories reset, repricing can be swift. Investors want clearer line of sight to margin stabilization, not just booking strength or backlog growth. Visibility into utilization, services attach, and software-led economics will matter as deployments mature and unit economics improve. There's a broader read-through, too. Peers investing heavily in accelerators and integrated systems may face similar margin trade-offs, which can influence multiples across the group. Up the supply chain, foundry, packaging, and memory partners could see shifting order patterns if Cerebras prioritizes configurations that protect margin, altering revenue timing. Credit investors will watch cash burn and the funding mix, since compressed margins can nudge financing needs and credit spreads. And for ETF holders, even steady broader markets can mask pocketed volatility when position-level drawdowns hit AI-tilted funds. The practical takeaway is simple. Focus on the path, not just the promise. Track gross margin trends against product mix, watch the conversion of backlog to revenue alongside delivery timing, and look for signs that utilization and services are kicking in. Keep an eye on cash runway and capital intensity, and size AI exposures with the understanding that scaling years can be volatile even when demand is real. Read the full article at finlitica.com. Quick reminder, this is general information, not financial advice. Your money, your decisions, so always do your own research.